Hello and welcome to the Stockout, a Memorial Day edition. This is a FreightWaves show about CPG companies, supply chains, and CPG companies' supply chains. So we're focused here on consumer goods. I'm your host, Mike Baudendistel of FreightWaves. Today we're going to be talking about a number of stories that suggest that consumer behavior is all the way back to pre-pandemic levels. Consumers are ready to leave the pandemic behind them, at least if you look at what they're doing. In addition, I'll talk about some recent trends in e-commerce and also some recent trends we're seeing throughout food supply chains. But first, a word from our sponsor. Our sponsor is Echo Global Logistics. Trust the experts at Echo Global Logistics for all your freight transportation and CPG shipping needs. Whether you are a Fortune 100 CPG company or a specialty food manufacturer, Echo has solutions to fit your needs. With their dedicated team as well as Echo Ship, a self-service shipping portal allowing you to quote, book, ship, and track, Echo has you covered. Technology at your fingertips and experts by your side, 24 hours a day, 7 days a week. To find out how Echo can simplify your transportation management, visit www.echo.com/CPG today. So big thanks to our sponsor, Echo Global Logistics. And on with the program here. So this week, there weren't any CPG companies that I know of that reported earnings. I think most of them have already reported earnings, but I did flag 8 topics that I thought were very important for companies in the consumer space, CPG companies and their supply chains. And so I've got 8 items on the list I'm going to discuss here. Item number 1 is these Fedex surcharges. This was a article that was posted on FedEx's website. It did a press release. In addition, Mark Solomon, our journalist who covers the package companies, he wrote this up, and actually Andrew Cox talked about it on his podcast, Great Quarter Guys. But this is one that I think is important for CPG companies specifically because they've done so much lately in e-commerce and it's really exploded. And so what happened here is FedEx increased peak surcharges. Yes, peak in June. These start June 21st, which is not exactly Christmas peak season, but I guess things are different this year. So they did this in 3 ways. The peak handling surcharges go from $3 to $3.50. So what that basically means is if there are shipments on FedEx that present difficulty because they're an odd weight, dimension, shipping characteristics, etc., that's not real efficient for FedEx to move, they're going to tack another 50-cent surcharge on top of the $3 they were already tacking on. Okay, so that goes from $3 to $3.50 for peak handling. The one that I think is maybe the bigger deal for CPG companies is this residential delivery charge. This one doubles from 30 cents to 60 cents per package, which depending on what's being shipped to this person's house, that could be, if it's a $5 item, it's a pretty big deal. So that's on each package, and a company shipping lots of packages that could be pretty significant. And then they're also increasing the package for ground economy. This is the segment that used to be called Smart Post. That goes from 75 cents to $1. And so that the one I think as I said, that people are probably concerned about in consumer space is this residential delivery charge doubling, and it's I think it has the potential to cut into the margins of companies that rely heavily on using FedEx for home delivery. I know Amazon doesn't use FedEx for home delivery, but a lot of I think the smaller companies do that for things that are relatively time sensitive. But this is somewhat counter to the recent trend in consumer space where the CPG companies are trying to market directly to consumers, not having to go through that retail middleman, help the consumer goods companies sort of control their own fate. And there's also been a big push to have subscription-based services. Some of those have been pretty successful. A few have been acquired by some of the larger CPG companies. You think about Unilever acquiring Dollar Shave Club a few years ago, and Nestle acquiring Persona Vitamins. It's a direct-to-consumer, personalized vitamin service that gets shipped to residences. So that's been a bigger trend here, and of late, consumers have been much more willing to buy their groceries online in addition to everything else. So if you're a company that utilizes those services, watch out for those surcharges. And this has cropped up as a lot of the parcel companies have demonstrated a deterioration in their service levels. I mean, we did see from some of the parcel guys, FedEx in March through April, 87% of their FedEx ground shipments arrived on time. That's versus 95% for UPS. And then in April, it was 71% on time for FedEx versus 88% for UPS. And basically, the volume of e-commerce, what we're all buying online, it far exceeds what any of these companies thought was going to happen. So people really took to e-commerce more so than they usually did. I mean, really, you tend to hear about occasionally these parcel companies struggling with fulfilling orders on time, during the holiday, shipping season. I mean, the busiest day for, package deliveries is usually about December 21st or 22nd, a couple few days before Christmas. And so this is unusual this time of year, like a lot of other things that we've seen. So, watch out for the peak surcharges, peak here in June. Second item here I have on the list is Amazon was hit Tuesday with an antitrust lawsuit by the District of Columbia, which alleges the company blocks sellers from on its marketplace from offering better deals elsewhere. And so what that means is that if I'm a company selling my products through Amazon, and let's say this product is $10 on Amazon, I can't sell it for $8 on Walmart or a competing website. And if you do that, supposedly Amazon sends you a letter saying, if you want to sell on Amazon, you need to have price parity, with these other websites. What we're not going to do essentially is allow companies to use Amazon as their showroom and then go buy it as a discount somewhere else. That's been contrary to what, a big part of what it seems like Amazon's strategy has been. Their strategy has been, you go to a Best Buy or a store and you use that as the showroom, and then you go and actually buy it on Amazon. So we'll see if this goes any place. I mean, it's potentially a positive for CPG companies if they are allowed to price discriminate in that way. If this sort of gains more traction, I will say that this is just an allegation, a lawsuit that violated DC law. So we're not talking about a huge number of consumers right now, but if this were to gain traction, it could potentially be a positive for CPG companies. Of course, not everyone is a believer that there's anything competitive about what Amazon is doing to consumer goods companies. There was an analyst from Capital Alpha Partners that said, well, really the problem with calling it anti-competitive is that it increases the competition by allowing the third-party sellers to use Amazon as a platform. The companies would be less competitive. Amazon said, okay, we're only going to sell our own products or certain products, and it's not an open marketplace where third parties can sell. So that's a potential positive for CPG companies, but we'll see if that goes extends outside of the District of Columbia. Third item I have on the list is double-digit freight rate increases are becoming more widespread. We've heard about double-digit contract rate increases in the truckload space, and as we've sort of gone through the second quarter, we're about almost 2/3 of the way through the second quarter at this point. We've heard more about double-digit rate increases from some of the transportation providers. There was just a good article on FreightWaves.com by Todd Maiden, who, like me, was a former analyst, and he talked about what J.B. Hunt had recently discussed with their intermodal containers. They recently increased their order from 6,000 to 12,000 because they want to get more capacity into their system, and are having a hard time getting those containers delivered from China where they're manufactured. And so that sort of goes along with the fact that they're raising prices. They're raising prices sort of across the board, really. Although there's particular tightness in the eastbound lanes from the West Coast. Those are the sort of the head haul markets in intermodal, and their contract rates are increasing. Double digit renewals. Same thing with competitor Hub Group, which is also in that domestic intermodal space. So not great news for CPG companies, although we probably knew that similar rate increases were coming. But I will say so far in the second quarter, I don't think rate increases have surprised to the downside. They've been at least as high, if not higher, than what people were anticipating going into the second quarter. So that's not a great news item for CPG companies. The fourth item I have on the list is consumers are shifting their spending to items related to socializing for the first time in a long time. So there was a good article in the Wall Street Journal called "The Great American Cleanup," and they talked about the various items that consumers are buying in more quantities now, and it's things like deodorant. You would think that people would be buying that anyway, but teeth whitener, perfume, nail polish, sunscreen. Various beauty products, things that consumers would buy to present themselves to others when they presumably go out during the Memorial Day weekend. It did see that 80% of people are planning to travel during the Memorial Day weekend, and that's versus 80% not traveling last year. So stands to reason there's probably going to be the worst traffic you've ever seen over Memorial Day weekend. That's probably going to be true of 4th of July as well. And then conversely, some of the products that are not selling well are things like baking goods, cleaning supplies. Clorox says they think people are going to continue their cleaning habits, after the pandemic. We'll see. Some of the retailers suggest that that's maybe not going to be the case. And some of those goods are way down after people bought them last year, that are a little bit more for staying at home type products. So, all these CPG companies are struggling with demand forecasts and just how much, consumer behavior is going to stick with their pandemic levels versus all the way going back to pre-pandemic levels versus maybe overcorrecting and making up for lost time. Right at the moment, it seems like, the vaccination rates, people have gotten more confident, and, even more so than maybe you would have expected a few weeks or months ago. So it does go also to one of the things I talked about in one of the recent, episodes of the Stockout. L'Oreal, has talked about, well, maybe we're going to have a big, makeup party like the 1920s where, makeup sales were going gangbusters. It seems almost like we're on that track. Item number 5. Corn futures hit 1 month low amid concerns about abundant supply. So this is a reversal of a lot of things I talked about recently. I mean, I've talked a lot about inflation in recent episodes of the Stockout, and I do think there's tremendous inflation throughout supply chains, right now. And I talked, recently about, are some of these inflationary trends transitory versus permanent? The corn future decline, which was down 5.6% on Tuesday and down 15% from its high on May 7th, that may be one that's a little bit more transitory in nature, which could be a reprieve for CPG companies that deal in food specifically. And the corn futures decline on Tuesday of 5.6%, that was in response to a USDA article or report that was published that said U.S. farmers planted 90% of their corn acres that they had ahead of the 5-year average of 80%. So 90 versus 80%, that makes sense. When prices are high, farmers will plant more corn, increasing the supply, bringing down prices. I think that still surprised the market, though, that it would be an increase to that degree. But nevertheless, corn futures are up 95% versus a year ago, and they're still up 28% in 2021. There's lots of pressure, keeping prices high, despite that recent pullback. One of those things is China is buying a tremendous amount of corn from its trading partners, including, U.S. And a part of that is an effort to rebuild their hog population that has been, decimated from the African swine fever, and then as people travel more, motor fuel uses a lot of corn as well in those blends. So a couple of things that are really going to keep, I think, the corn prices elevated, but maybe you get a little bit of a reprieve there. I should also mention that the Canadian railroads as well as the U.S. railroads have been moving record volumes of grain, westbound to the West Coast ports of, Seattle, Tacoma, as well as of, Vancouver. Item number 6, food supply chains are strained for restaurants. So this is somewhat reads like a reversal of what we talked about at the beginning of the pandemic, where there was a shortage of food for groceries, and we had too many sort of getting rid of kegs of beer that were spoiling but didn't have enough bottles. We're sort of having the reverse situation now, where the restaurants are the ones that are short on supplies. Restaurants have really been surprised the past 6 weeks that demand has come back faster than they would have anticipated. So people are feeling confident once they've gotten that vaccine. Some of the companies have reported shortages of raw materials, or they're not having enough chicken. I mean, chicken wings have been in short supply. Pepperoni has been in short supply. Some of those items. And so what this means for CPG companies that probably just deal with grocery and big box retailers is it does show that a lot of their demand that they took advantage of during the pandemic, I think a lot of that is going away, and it's going back to people that are to restaurants as people go out more, and so I think that's a negative for CPG companies' demand. I think it will make it easier to keep their products in stock, but it does seem kind of in general that people are going back to their pre-pandemic lives a little bit faster than maybe they thought possible before. Seventh item on the list is here, I think is an interesting one. It's the U.S. initiates trade dispute against the Canadian dairy industry. So the Biden administration initiates a dispute process against the Canadian dairy industry, triggering the formal mechanism of the USMCA for the first time. So this is USMCA was sort of basically the new NAFTA, basically an agreement in North America to basically a free trade type agreement. And what U.S. is alleging here is that there is essentially a quota for Canadian dairy, that basically Canada's going to use Canadian producers for a certain percentage of their dairy, and that's allegedly in violation of the USMCA. I mean, I think this will be an interesting one to watch because this is the first time that this this has been tested with these procedures, so it could set a precedent for other types of disputes. And the Canadian dairy protection was one of the key sticking points of the USMCA agreement in 2018. So we'll see what happens there, but I think that has pretty big implications for the price of dairy if it's a situation where the U.S. producers can't sell as much in Canada as they want to. Maybe that depresses prices a little bit for U.S. buyers. So I think you could have implications for CPG companies and their supply chains. I mean, you do see a lot of the confectionery companies is just sort of one example of companies that use dairy in their supply chain for things like milk chocolate. Eighth item I have on the list, this is sort of going back to the e-commerce trend, is grocers are supposedly losing money on home delivery, which is of course unsustainable. This was in one of the trade rags, and basically the profit margin on groceries is thin, as we all know. It's typically 2 to 5%. I mean, even it's probably typically maybe closer to that 2% level. So there's not a lot of room to absorb, extra costs. And just earlier we talked about how there's if you were to use FedEx, there's a surcharge there for home deliveries because home deliveries are less efficient. Other delivery companies are probably going to have something similar, there as well. And what the grocery strategy has sort of been to gain market share, get consumers in the habit of getting their groceries delivered online, and then from there. They'll figure out a way how to make those profitable, and so I think what's going to happen here is you're going to see more automation for things like picking orders, packing orders, all these things to reduce labor costs. I mean, labor costs are one thing that is certainly inflationary, specifically for some of these lower paying positions that grocery companies offer and various food companies offer. So there's going to be more automation there, but also it's going to be something that the grocers are going to have to figure out. It seems like the consumers are more willing to get their groceries delivered, but the question remains: are they willing to pay for that convenience, or is it something that they're going to expect the grocers to absorb? Which at some point they just aren't going to absorb that because it's a low margin business. So I think that's something to to keep an eye on is what's going to happen there. And those are the 8 things this week that caught my attention in the world of CPG companies and supply chains. If there are others that you think I missed, feel free to reach out to me. Email is mbowdendistel@freightwaves.com. And feel free to write me an email anytime, or to sign up for the FreightWaves Stockout newsletter, which you can sign up for that at www.freightwaves.com/the Stockout. But with that, I'll wish everyone a safe and happy Memorial Day weekend, and talk to you next week.